Hello and welcome to this catalyst breakdown of SMCI. In this video, I'm going to break down and explain why this was a good catalyst and what the key fundamental drivers were and what made it such a high conviction trade for me. Let's get right into it. First, let's look at the quality of the catalyst. This was a classic earn-in pivot driven by a double surprise in their guidance. So they released two main headlines. The first one was that they had a 60 billion backlog in their orders. And the second was that they raised their gross margin to 17% from an initial 8.4%, which is essentially doubling their gross margin for Q4, which in my opinion was the primary driver of this move. Now let's try to understand how institutions would view this. In my opinion, this was significant because up until this point, SMCI was in a bear market. Wall Street was treating SMCI as a low-margin commodity hardware assembler with significant margin compression risk. They are essentially a hardware company, and out of a sudden, they are doubling their margin outlook. So that instantly crushes that bear case. It proves to institutions that SMCI possesses high margin pricing power. In other words, that they can profit from this business significantly more than what the street thought. So this classifies this catalyst as a grade A structural fundamental reset. The two main headlines, which both were very good, but which one was the most significant? Because that's what I'm always looking to determine, which is the key point or the few key points that made a catalyst spark a surge. And I think it's the gross margin doubling, and here's why. First off, a 60 billion backlog of orders is of course extremely significant, but I don't think institutions are so surprised. So it didn't take the market by extreme surprise. But the second and most important thing is because a backlog is only as good as the profit margins on that backlog. So if they're making 60 billion, but like their margins are really, really low, it is not as impressive. But now they're saying, oh, actually they can make double as much as what the street thought. So this is very, very significant. Having a massive order pipeline doesn't mean much if you're executing at a razor-thin margin, or worse, getting squeezed by supply chain or eating tiny profits on high volume hardware. But doubling the gross margin forecast proves that every single dollar flowing through that 60 billion backlog converts into, some very good profits. So it completely reframes the quality of this new revenue stream. And now let's talk about price action, because that also comes into play. And here there were some interesting signals about where SMCI was headed. The pre-market action was somewhat ugly. So when the news came out, that sparked an initial rally here. Went all the way to $31, but then it just spent today's morning fading the move and opening as low as how much was the open? Anyway, around $28. But here's what happened at the market open. So I'm looking at the 1 minute chart here, and I see the first candle is a green candle with a, how much is that? 4 million? Yeah, 3.96 million shares traded, and also a dollar volume of more than 100 million on that first candle. Then followed by a red candle, which also was, it was 2 million shares, but it's still less than the first candle in terms of volume. But then the third candle and then the fourth candle followed. They were green candles, green volume, and pretty decent dollar volume that is at least as much as the red candle. And I don't see any other red candle following this first one. And so here's where I entered. I think I entered at 29.5 because I could see that institutions are stepping in and they are setting the tone for today's price action for SMCI. And here I want to make an important distinction between micro caps and medium to large caps in terms of pre-market price action. There is an important distinction to make here. On the microcaps, messy and choppy pre-market action is usually a bad sign because of the low float. So the float dumps very quickly, and you can see it at the open. You can, well, around the open anyway. On mid and large cap with very good news like this, sloppy pre-market action often represents institutional algorithm absorbing early liquidity. But then once the opening bell, which is why it's very important to watch the open, once the opening bell rings and the true market volume arrives, if you see volume anyway, it means institutional orders are coming in. The flow is taking over, and that flow will establish the actual directional trend of the day. Passing on the pre-market chop, in this case, was a very solid exercise in trading discipline. And so to summarize the core lessons from this case study of SMCI, the first point is that margin resets outweigh revenue beats. Of course, having both is the best, but in the case of SMCI, revenue guidance actually came in near the low. They guided between 11 to 12.5 billion, and they came in with 11 billion. So that's really on the lower end, but yet the stock surged nearly 20%. But that was on the back of the gross margin being raised and nearly doubling from their initial guidance. The second point I would say is that structural resets provide clarity. And that's very important. When a company demonstrates a fundamental expansion in margins, it changes how Wall Street calculates their future earnings. So that covers the breakdown for SMCI for me. If you found this analysis helpful, give me a like, subscribe for more Catalyst breakdowns, and thanks for watching.